Welcome to the Money Answer Show with host Jordan Goodman. Whether you are starting out, deep into your retirement, or somewhere in between, the Money Answer Show has the know-how to help you. Now here's your host, Jordan Goodman.
Welcome to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is John Hoffmire. He's the former chair and still on the board of the Personal Finance Employee Education Foundation, known as PFEEF. He is also a professor at the University of Wisconsin-Madison, and currently he is at Oxford, at the Business School at the University of Oxford in England. Welcome very much to the show, John.
Thank you, Jordan.
I just gave a little bit of brief, but just give a little further of your background and how you ended up here at Oxford.
Well, I'm a business person by most definitions. I was a Bain consultant many years ago after I finished my PhD at Stanford. I then had the opportunity to start an investment bank and was able to sell that and then worked in the venture capital industry for a while. But I've always been interested in personal financial literacy. And what we learned through the employee ownership transactions that our investment bank did was that we could help people get more money into their bank accounts, but we couldn't help them keep it without financial literacy.
And just tell us a little bit about PFEEF, which is, again, the Personal Finance Employee Education Foundation. When was it started and what is its mission?
Well, Tom Garman started it more than a decade ago. He was a professor at Virginia Tech and probably the best known person during that time in the side of the personal financial wellness movement who was focused on employers. That was always Tom's interest. And so to build the Personal Finance Employee Education Foundation was just a natural for Tom. And he ran it for a number of years and is retired now, but still active more broadly.
So let's just kind of take a broad look. We're going to get into the specifics, but a broad look at personal finance education in the workplace today. Is there a lot of it going on? There's more or there's not enough? Just kind of give us a broad view of what's happening in that field. There's
more and not enough. And if you were to look at the growth, it's been in a few different areas. You've seen a growth in 401k companies showing interest in financial literacy. There are a number of large players that are in the market, private companies that just deliver financial wellness type of training and support. And that actually breaks down into a number of different areas. There are some great online companies. I could name some of those if you were interested.
Sure.
So the Financial Fitness Group, Financial Finesse are two of the biggest players in that market. Financial Finesse also crosses over into a number of different types of training and support. There are others who work on coaching and much more of a one-on-one basis. And then there's some groups that also have lawyers who are part of their staffs and play a role in helping employees work out financial difficulties, sometimes by going through bankruptcy, sometimes through other forms of workouts. So it's a pretty broad range of services being provided.
Now, do employers see a rate of return? I mean, when they put in these programs, what is it for the employer?
Well, the big advantage is if they can help employees that the employers want to keep staying in their jobs, they don't have to, hire anyone else, and that can be expensive, and I can tell you more about the costs that we've discovered there. But you also then don't have to train someone else who might come in and take that spot. So that's where the big savings are found. And I think you'll find it interesting that one campaign that we ran ended up having, and this number no one believes, so I always hesitate to use it, a 7,000% return on investment. Now, it wasn't a large investment. We haven't replicated that in many places, but the savings can just be huge for companies that run these types of campaigns effectively.
So it's turnover is the main thing in training, but also isn't there something, maybe it's more intangible, about the employees being able to concentrate on their jobs if they're not worried about their financial situation?
Yes, and that is more difficult to quantify. But I believe that in many cases, especially, and let's put the context around our conversation. We've got the COVID-19 situation looking us in the face, and with that, there's an incredible amount of stress. I can just give you one statistic from a study. If someone has their own office and they are looking at going into bankruptcy, or they are already in bankruptcy proceedings, they spend 40% of their time at work working on their own personal financial situation. You can imagine that person's not being very productive for their employer.
Yeah. Well, let's talk about the current situation. So the whole world has been upended in the last month or so. Vast millions and millions of people are working from home that never did so before. What is this going to do to the workplace going forward and the ability to do financial education?
Well, I think what we're going to find is that more and more of it is done online. And there's been a lot of success found in that field. There's been enough years now of experience that many people have really figured out what some of the secrets in the online financial wellness world are. And I actually hold out some real hope for that. I think there needs to be support that goes beyond simply making available online platforms. For example, if employers are really interested in working on this during this time of great stress, I would tell them that they ought to take the classes as well, right along with the other employees. And if there's any way to build a contest into the whole program and really make it seem like a political campaign where everybody's participating, everybody's being rewarded if they do well. Frankly, anytime someone is paid to participate in these either online or other types of financial wellness campaigns, it's much more likely that they will participate. But with the right type of support, online education around financial literacy and financial wellness can work very well.
So also, since a lot of people are working from home and things are working relatively smoothly, in a more general sense, do you think this is going to change the nature of work? I'll just give you an example. The stock exchanges, New York Stock Exchange and others, are closed, and yet trading continues fine without a floor being traded, and many other places the same thing around the world. Are employers going to reconsider the need to have people come into the office and congregate to do things that seem to be working pretty well fine remotely?
Well, I think it's really important that we're all as optimistic as we can be at this particular point in time. At the same time, I think it's really important that those of us that have certain feelings express them, especially if we can do so kindly and in ways that don't lead to arguments. My personal feeling is that we're going to find more and more roadblocks to working at home. We're going to find more inefficiencies than we thought we were going to find. And let's face it, there are a lot of jobs that people simply cannot do from home. And I'm not just talking about manufacturing jobs. I think there are other types of jobs where relationships are just so important. I spend a lot of time working in Asia. And if you don't meet people face to face, it's very difficult to really make the progress that you want to make. Perhaps I'm going a little bit far afield right now, but if we look at where growth is going to be in the world economy over this next period of time, Asia was and probably is still going to be the area where there's growth. And I think some companies that want to get out and participate in growth markets are probably going to be opening up sales channels to Asia. And it's going to be difficult to do that without face-to-face contact.
So you have the situation today where many employers are barely hanging on to be able to pay their employees today, or not being able to pay them. And I mean, last week we had 3.2 million unemployment claims, and that's probably understated because a lot of people can't get through to even file for unemployment. What kind of financial advice would you give to employees facing this kind of uncertain future today?
Well, really, the answer to that question is very much like the answer to the question of how do you create a financial literacy or a financial wellness program at work. So both in answering your question and when you are opening a campaign, you want to segment your workers into different categories. Those that have savings are in a completely different situation than those that don't. You need to look at the age groups and different elements of demographics. Those who are close to retirement both need certain types of programs, whether they're employed or not employed. Those who, let's assume employment for a moment, and that we are trying to focus a financial literacy program on them. You'd want to look at age groups where buying a first home was something that somebody might still want to do. And I think we can project in certain markets that home prices are going to go down. That probably wouldn't be a bad investment for some people in that particular demographic. For those who are of a marrying age and thinking about what that might mean to their personal finances, some training around those types of issues would be important. For those who have children who are college age and thinking about going to college, if the parents have the ability to help, helping those parents plan to help fund a college or a university education would be important. But I think at the very base of your question is, what are we going to do with those millions of people that are not going to have work? And that's partly a governmental issue, but I think it's also an employer issue. And if you don't mind my just going on for another minute, perhaps you'll want to ask me a follow-up question so I don't
No, that's
go
right.
on too long
How
here.
are companies going to maintain their employees if they can't pay them? Some of these employees may disappear and they couldn't put the team back together again that they had before.
Well, I think that's a real issue. And in fact, that's exactly where I was going to go. I think one of the opportunities that employers have right now has to do with thinking about having, let's assume that these are companies that have not let go a huge number of employees already. They're still trying to decide what to do. There are many discussions that are happening in great companies right now about having employees go to a 4-day week where everybody is working 32 hours rather than 40. That opportunity enables not only for people to keep their skills, but to keep a job. And then to your point, when the time comes that the economy grows again, that company already has the people that it wants, and it has an easier time expanding.
Yeah. Okay, we're going to take a break. This is Jordan Goodman of the Money Answer Show. My guest this hour is John Hoffmire. He's a member of the board and former chairman of the board of the Personal Finance Employee Education Foundation, which is PFEEF, and you can find out more at them at pfeef.org. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is John Hoffmire. He's the former chairman of the board, still on the board of the Personal Finance Employee Education Foundation, which you can find out more at pfeef.org. He's also a professor at the University of Wisconsin-Madison and currently is a professor at the University of Oxford in England. Welcome back to the show, John.
Thank you, Jordan.
Let's get into some of the specific areas that employees need more financial education. Probably the biggest one is retirement planning. So what is the kind of advice you can give to employees that they're doing wrong and they're doing right as far as asset allocation so that they're going to, when they retire, have a decent amount to live on?
Well, that's probably the most difficult question to answer in the world right now. And if I knew the answer, I would know exactly what to do with my own decisions about having a higher percentage of our resources in stocks. I hesitate to give advice on these type of topics, but if we were calling this more just a conversation between two people, and it happened to be the case that some people were listening in, then I don't feel so uncomfortable.
Okay, that's fine.
Okay. And I don't have a license
to
talk about these types of issues. But I think that for those people who are already in the market and who are looking at retiring sometime out into the future, certainly 20 years, I would simply stay in the market. And if they have enough resources to live off of right now, either a paycheck or lots of savings, I think staying in the market is a very useful thing to do at this point. It was interesting for me to read over the last couple of days that somewhere it's only between 6 and 12% of people in the United States have sold. And so the vast majority are holding. And I think that's a wiser strategy. For those like myself who have been out of the market this past period of time, I think it's really difficult to know what to do. And so what we're trying is to average into the market every 2 weeks, putting around 5% of what we mean to have back in the market into the market. And I think if we can get back to a high percentage of stock ownership, maybe with some gold as part of the mix, that we'll feel good about that. And now, if you want to call me back in a few weeks, if the stock market shoots up really quickly before we're able to get back in, I'm going to feel fairly bad.
Okay. Now, one thing I hear from employees that they're being offered too many choices. They have 50 funds or 100 funds. It's just some huge number sliced into all these small pieces. And they get overwhelmed by having so many choices and don't know how to allocate amongst all these choices, in addition to their own company stock. In many cases, they're matched in their company stock, and they end up getting a lot of concentration in their own company stock. How would you recommend that people go through all these different choices, including their company stock, to allocate appropriately?
Well, having heard you raise the company stock issue, given that that's what I wrote my dissertation on years ago and practiced for over 20 years, I'd like to spend a few minutes on
Sure.
this, if that's okay. Because the number of different types of employee stock ownership plans in the U.S. is fairly large. For those who are in ESOPs, employee stock ownership plans, using that formal definition, they're going to be forced to diversify their holdings at the age of 55. So I don't worry about people in ESOPs, and those that are there should stay there if they can. All of the research says that those companies do better. Their stock rises at faster rates. Layoffs happen less at ESOP firms. And for a very large percentage of all ESOPs, there's an alternative retirement plan that pays just as much as most companies' retirement plans. So the ESOPs in those situations are gravy. And anybody who listens to the don't put your all your eggs in one basket, you shouldn't be at an employee-owned firm, they really need to think twice about leaving if they're part of the ERISA retirement plan called an ESOP. Now, let's back up to your question, though, because you were probably referring more to when 401ks
Right.
Use a match of employer stock. And there are plenty of examples going back even to Enron, where that can just be a huge issue, especially in these types of times. And then there are stock option plans, and the number of flavors there is very large. So these plans are not easy to read, but every now and then it's worth even a couple of $1,000s for someone who has that money. If for some reason they don't understand and the human resource department is not explaining everything in a way that makes sense, go out and spend that money on a professional who can really give you good advice on the stock from your own company. I'll stop there. But I think you were getting at some broader issues as well. So take me back there and let me see if I can't help in a broader way.
Well, because people, again, have all these options, employee stock being one of them, but they're overwhelmed. And my experience of human resource departments, employee benefit departments, they do not want to take any risk whatsoever in recommending anything. So people maybe they'll go to a seminar put on by the fund company that offers them the options, and that's about it. People are pretty much fending on their own to how to make these choices, which in many cases are overwhelming. There's just too many choices. How do employees handle that?
Yeah, I think it's really important to look at research on these types of topics. I don't know what the right number in a financial services 401k type of situation might be, But I know at grocery stores, there's been a lot of research on how many choices to give people. I can't remember what the famous study was. It might have been jams or some type of condiment. I think it was 7 was the right number of choices. And if you put more choices on the shelves than that, people actually bought less. And so understanding the behavioral economics in these type of situations is really important. And I agree with you. If there are too many choices, that just makes people freeze up. And I don't think it's irresponsible for a company to actually offer fewer choices, especially if the choices have a variety of stocks in the portfolio, a mutual fund, and that people really understand when there's a mix of bonds and stocks that can see what the mix is. And if it can be explained whether those are long-term bonds as compared to short-term bonds, I think that makes a difference also.
What kind of asset allocation should people have, and should they change it with changing times? I mean, a case like what's happened recently, where the stock market fell sharply and the bond market rose sharply in price, their allocation is going to be way out of whack from what it was a month ago, with their stock allocation being lower and their bond allocation being higher. Should they have some kind of a system where they automatically rebalance to get back to even, or what advice would you give them on asset allocation?
Well, I think there's a short-term and a long-term answer to that. We are in such uncharted times. So if before this crisis, we were looking at somewhere in the neighborhood of 400 trillion of wealth in the world, and I realize that government debt is not wealth, but at some level, comparing the amounts of money that are going to go in to address some of these real problems that we have, already we've had more than 2 trillion go in the U.S. Across the G20, we were looking at 5 trillion last week. It won't surprise me at all if we don't get to 20 trillion worldwide. And then I think there can be other monies that will also be put to use that probably won't be counted in the same way. And then depending on what you think the amount of debt in the U.S. or worldwide was before all of this started happening, you can get to some situations where over the short term, it's very difficult to imagine that some people won't start saying things and maybe be right about how the government is printing too much money. So that's the short-term problem. Do you want me to address the long-term asset allocation?
Yes.
So if the short-term allocation involves perhaps more investment in gold and making sure that there are some abilities to protect oneself against inflation, which is often what comes when a government prints too much money, then perhaps the long term is to pull back out of gold and actually spend some time looking at what the price of gold has done in different types of environments. I've actually never owned gold in my life. I just bought it for the first time last week. And I think some more people are going to have a higher percentage of gold in their portfolios. I think once this crisis is over, that may fall back again.
So you think that all the money that the Federal Reserves and the central banks are printing and all the stimulus programs from governments are potentially going to be inflationary? I mean, the argument against that is that the coronavirus and the shutdown of economic activity is contractionary and deflationary. But you think
there's no doubt. That's the reason I'm trying to bring the time scale to this. And so I think for people who are buying gold right now, they're probably thinking 2, 3, 4 years. But anybody who thinks that there's going to be a lot of inflation immediately is probably thinking wrong.
So I know we're in uncharted territories, but what time in history would you help look at that gives you some guidance? I mean, is the crash of 2008 or 87, is the depression of the 30s? What gives us some guidance for what we're in now?
Well, if you go back and look at what happened with the price of gold in that same time frame I was just mentioning, 2, 3, 4 years after the crisis, that's when gold really spiked. And I think there was an expectation on a minority's part that the same types of problems could have happened. after that run-up of government support. So I think that's the best place to look. I think it's very difficult to go way back in history and find many trends that are incredibly applicable to the present.
I guess they didn't have too much of a stock market in the days of the Black Plague, right?
No, they didn't.
Okay. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is John Hoffmire, former chair and still on the board of the Personal Finance Employee Education Foundation. You can find out more at pfeef.org. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is John Hoffmire, former chair and still on the board of the Personal Finance Employee Education Foundation, known as PFEEF, at pfeef.org. They're an organization to help improve personal financial literacy in the workplace. Welcome back to the show, John.
Thank you.
So what other things can employers do that can help improve financial education and literacy in the workplace?
Well, let's just take some major topics, and any of these that you want me to delve into, I'd be happy to. So one of the things that's going to happen as we address this crisis, whether this is for people who are in work or out of work, the whole tax system is going to be used to a significant level. The Earned Income Tax Credit is the largest cash-based anti-poverty program in the United States. And for any employer who has very low-income employees, helping employees understand what to do there is incredibly important. For higher income employees, just making sure that everybody is getting some advice on how to handle the tax code, I think is going to be essential. A second area has to do with building and maintaining good credit. This is really unfortunate, but there are going to be a lot of people who lose their good credit scores over this period of time. And for employers to actually help their employees just learn more about what a credit score is to start with, but then also to help the employees take a step toward improving their credit scores once this mess is either partway over or all the way over is going to be incredibly important as well.
Let's get into that in some detail. So say somebody's getting paid less or laid off. As a result of that, they just do not have the money to pay their bills, and they're going to start getting latenesses and non-payments on their credit report. What can they do to keep their credit score up?
Well, again, we need to segment the market. And for some people, they don't even have a credit card yet, but they're still causing themselves trouble and creating difficulties in ever buying a home. So young people in particular are having that issue. The right step for them is at some point along the line here is to actually get a credit card. That may sound counterintuitive, but if either an employer or a parent can really help a young person get on an automatic payment plan with that credit card so that the money is always coming out of an account somewhere, that's a way for the young person to improve credit. For someone older, it probably is the case that there are so many different categories of how somebody would improve their credit that I don't want to get into a lot of detail, but you can imagine that it's different for somebody who's a homeowner as compared to a renter. It's different for somebody who has high income as compared to low income. But in every one of those cases, there's somebody who can help. And the credit score is one of the parts of the financial world, as you know, Jordan, that people know less about than almost any other part of the financial system. So to do some training there is just essential.
How about a student loan interest? I mean, so many people are burdened with student loans. Some employers are starting to allow people to pay off their student loans in various ways. What can employers do to help people deal with this huge burden of student loans?
Well, I'm really happy to tell you that I know some companies that are actually playing major roles in helping people pay off their student debt. There's one investment bank in Chicago, Prairie Capital Advisors, that I know, which it's part of their employee benefit package is to help people pay off those debts. I think that's just an incredibly creative approach and something that more companies ought to look at.
Another area is healthcare. We've had a lot of changes in the whole healthcare insurance industry, and most people get their healthcare through their employers, but that's been changing. Premiums have been going up. They're putting more of the burden, deductibles and so on employees. How should employees handle the whole healthcare situation better?
Well, you need a crystal ball for what's going to happen in the November election, but I think especially with healthcare being at the very, very, very fulcrum point of the COVID-19 crisis, that we're going to see that being a major, major issue as the candidates go into November. If things break toward the Republicans, it's not clear to me what they're going to do. The Democrats seem to have stepped back from the one-payer system. I don't know exactly let's assume Biden's the nominee. I'm not sure what his plan is really going to look like. It's probably a continuation of Obamacare. So depending on which of the two candidates wins, I think employers are going to be recommending one thing over another. I don't want to spend a lot of time on this next point, but during the last crisis, very few people are aware of this, but at very large employers, like at the big auto companies, there were negotiations that helped save those companies and actually made a lot of money for the employees as they negotiated over Cadillac plans and gave up some of the rights they had in exchange for shares. So there's so much in this area that we could spend the whole hour just talking about this.
But how can employees, say they have a choice of an HMO or a PPO, there's many different plans. How can they figure out what's best in their own situation if an employer offers them different choices?
Well, again, you need a crystal ball. Do you want to give me an assumption of how many people are going to die over the next few weeks?
At least 100,000 in America, at least 100,000.
Well, and then there are going to be somewhere in the neighborhood of 10 to 20 times that many, at least, who will get sick.
Right.
So, this is not just something that people need to be thinking about long term, but if people are not in healthcare plans right now and they have the ability to do so, I've heard that the Obama care lines are still open in a number of states. And for anybody who doesn't have health care, I would say that's probably the single best investment they could make.
Yeah. I heard that the health insurers were going to be raising premiums some 40 or 50% because obviously they were not counting on this level of healthcare expense.
No.
It's going to be a huge burden on them. So you think there'll be a lot of premium increases going through that employers will pass on to the employees to some extent?
This is not something I specialize in, but I would certainly guess that would be the case. I mean, we've been seeing it even before this crisis. So yes. To think that it wouldn't continue, I think probably would not be the right assumption.
Yeah. Okay. Very good. All right. So we talked about taxes. We talked about credit. We talked about health care. Another thing that employers tend to offer is life insurance, group life insurance. And you can often get even more than the minimum. Is that often a good idea for employees to take them up on that?
Well, I think it all depends on what type of insurance. I don't believe that whole life is a good investment for hardly anyone. But if somebody wants to buy term and life insurance through their employer, I think that can make a lot of sense. And often it's subsidized to some degree. And I know that my wife really likes me to have some life insurance. It's probably not the best investment that we've ever made. I mean, the computer tells me that I'm supposed to live to 103.
No.
So I mean, that's probably not a good investment even on a term basis right now, especially given that I'm completely isolated right now. But for many other people, I think it does make sense. And, there are some other areas that I'd love to cover that also can be of real value to employers. Do you mind if I mention one?
Go ahead. Mm-hmm.
So you know that I have a special interest in low-income employees.
Right.
It turns out that that vehicles end up being just an incredibly big part of whether or not people keep their jobs or not. This is true in many different areas of the world. You find where there are gambling institutions, though, that it's even a bigger issue. People don't maintain their tires as well when there are a lot of gambling institutions around. Of course, this is not everybody, but all it takes is a certain percentage of people who don't maintain their cars, have cars break down. They've already used up as many vacation days or leave days as they have, and they get fired simply because their vehicle doesn't work. And I think that it makes a lot of sense for employers to focus on that particular issue and just ask, what can we do to help your car stay on the road? Again, this is something that has a return on investment where if you want to keep your good employees, many times helping them have a good vehicle is a step in that direction.
So what do? Do they loan them money or do they pay for repairs of the car? What does an employer who cares about this do?
All of those things. They can have a special fund established where all the employees come together and make sure that they're able to help whoever has a problem during a given month. That's kind of a microfinance approach to helping cars stay on the road. But given that almost everybody is going to have a car problem at some point, to have almost an insurance plan inside the company. The employer doesn't have to put a lot of money into that, just to make sure that something is there to help people establish what is, in essence, a rainy day fund. And I know that you've talked about that and had many people on your show bring that up, but people don't have rainy day funds. And if the two areas where people get, and I'm going to use the word killed, and it's a little bit too strong a statement, for the not maintaining your car side of things. But if there are two issues, one is a health problem and the other is your car breaks down, that's where people really lose it in regard to their financial wellness.
Do you think a lot of employers recognize that?
No, and it's a huge issue, and they're not aware of it to any great degree at all. I said earlier in the show that I'd give you a statistic about what it costs to train a worker that you don't want to lose. These figures are a little old. I'll tell you what the figure was and then speculate on how much it's risen. But for McDonald's, it was $5,000 about 10 years ago to train a new employee. And so that figure has probably gone up by 3% a year. And so you're looking somewhere $6,000 to even train a worker at McDonald's. And so when you look at the cost of hiring somebody that you didn't want to lose and then hiring someone to replace the person that you didn't want to lose and then training that new person as compared to just putting a little bit of money in to help get a collective insurance plan for people to take care of their cars, it's money well spent.
Indeed. We're going to take another break. This is Jordan Goodman of the Money Answer Show. My guest this hour is John Hoffmire, former chair of the board and now a member of the board of the Personal Finance Employee Education Foundation. You can find out more at his website, pfeef.org. We'll be back after this.
You've been listening to the Money Answer Show with Jordan Goodman. If you have a question for Jordan or his guest, please call us now at 866-472-5790. That's 866-472-5790. Now back to Jordan.
Welcome back to the Money Answer Show. This is Jordan Goodman, your host. My guest this hour is John Hoffmire of the Personal Finance Employee Education Foundation. You can hear more about him and what they do at pfeef.org. Welcome back to the show, John.
Thank you again.
One other employee benefit people have to choose of is disability insurance. There's short-term disability and long-term disability. Often they can buy additional coverage. Is that often a good thing for employees to do?
If they can afford it, it's one of the components of a total plan that just makes absolute sense. That long-term insurance, though, is so expensive. You can imagine what it costs if you need to have somebody take care of you 24 hours a day. And that cost is prohibitive for almost everybody. So making a decision about what you can afford, I think, is really important.
But do you get a better rate if you get it through your employer than if you went out into the market and got a long-term care policy, individual one?
I'm sure you would, but I don't know the figures there.
Yeah. Another place that offers financial wellness training for employees are called EAPs, Employee Assistance Plans. Just talk a little bit about those and what role do they play in delivering financial wellness education to workers?
I think you need to separate the good from the bad there. And I'm not saying that EAP programs are ever bad overall, but given how many different issues an EAP program might be dealing with, everything from divorce to healthcare problems to legal matters, if you have an EAP that is not well aware of what really needs to happen around financial wellness, you might be giving short shift to your employees with the wrong EAP program. My personal belief is that anytime someone buys an EAP program, they really ought to look seriously about what the components of that EAP program has around financial wellness. And if the attributes of that plan are not good enough, then an employer should not go with that EAP.
Yeah. You have a way of kind of grading employers and how they're offering personal finance training. There's something called the Personal Finance Well-Being Scale. Explain a little bit about how that works.
Well, first of all, we believe in measurement. And if you just look at how things work throughout the world, companies are measured on their performance, baseball players have statistics. It matters that things are measured, and people will often manage better if they know that they're going to be measured. So what we have provided, and this really has been the almost the golden standard of measurement in the financial wellness world, is our personal financial wellness scale and score. It's based on 8 questions. People answer these questions along a 10-point scale. It's interesting to note that one of the questions was borrowed by President Obama's people when they came up with their own sense of what a survey that could be used more broadly outside of employers. That question has to do, my guess is that many of your listeners have heard this question, can you come up with some number of dollars within a certain period of time if you have an emergency? That's our question. And it's one of, again, the 8 questions that we ask at the beginning and sometimes in the middle of a program that's meant to intervene and help people become more financially well. And then certainly we always want to go back and ask these same questions again once a program is over to see what kind of progress has been made on the employee's part.
Now, some people say that the lack of financial education, or it's not being evenly across the employee base, is contributing to inequality. And everybody's complaining about the top 1% having so much in assets and everybody else kind of being left behind. What role can personal financial wellness training play in creating less inequality in the workplace?
Well, I think it can play a role in a number of different ways. It's interesting to note just what a crisis we have even without the COVID-19 situation. So if you went back to the 1960s through 1980s, we had savings rates of 11 to 13%. Fortunately, it's gone back up since the Great Recession. We're at about 7.9 right now. In the 2005 to 2007 stage, we were in the mid 3s. So on the one hand, we're doing okay. But then when you start breaking down how many people are living hand to mouth, it's probably 2/3 of Americans now that have less than $1,000. And if you then start looking at what's going on with even fairly high income, well, in fact, these people really are high income. At $150,000 per household, we still have a quarter of people who are without any emergency savings. So, I think it's important that we think about those who are least fortunate. But these problems exist at every single income level, up to points, probably around a couple 100,000. And below that, we've got people who are suffering already and are really going to suffer as the COVID-19 problems kick in.
I've heard there's a lot of people who are offered matches on their 401ks, but don't take the employer up on it because they just don't feel they can afford to give up any money to be matched. Is there something that can be done about that to get higher levels of percentage of people accepting the match offered by employers?
Well, I think one thing that can be done, and this is not very easy to do in the climate that we're going to be looking at, but if employers simply make the contribution without requiring a match, that often is just a fabulous thing to do, and it takes into account the behavioral economics of sort of taking options away from people and nudging them towards something that's good for them. So, that's one thing that can be done.
We have about 2 minutes left. Why don't you kind of sum up the situation as you see it now? Are you hopeful that there's going to be more financial education and employees are going to do better, or you're not hopeful?
Well, again, I think we need to look at stages of what's going to happen over these next few years. Employers are going to cut all kinds of training programs over the short term. I think that's completely understandable on the one hand. I think it can be short-sighted, especially for the companies that can continue to afford something around these types of issues. When the time comes that training is part of corporate budgets, there's no doubt that the return on investments of good financial wellness programs make it almost a requirement that employers move in that direction. And I'm just going back to the inequality issue that we were talking about a minute ago. I would argue that if employers don't take this seriously, that our society really has an opportunity to break down. And I'm not going to try to predict exactly how that will happen, but I do believe that if we don't start doing more through the workplace to train people to save, in effect, that society could face really large problems.
Yeah. Well, we've covered a lot of different ground. There's many different benefits being offered by employers to employees. They're not all taking them up on it, but hopefully by getting employers to understand this and employees to take full advantage of it, we can have a more educated workforce financially. So thanks very much. My guest this hour has been John Hoffmire. He's the former chair and still on the board of the Personal Finance Employee Education Foundation. He's also a professor at the University of Wisconsin-Madison and currently at a school in the University of Oxford in England. You can find out more at his website of the organization, PFEEF.org. Thanks so much for being a great guest on the Money Answer Show, John.
Thank you, Jordan. I've enjoyed it.
Thanks again, and we'll be back next week with another edition of the Money Answer Show. Goodbye for now.
Thank you for joining Jordan Goodman and the Money Answer Show. If you have a question for Jordan, please visit his website at www.moneyanswers.com. And be sure to tune in every Monday at 12 p.m. Pacific Standard Time right here on Voice America Business. See you next week.